The behavior that we saw in the Chinese stock market, the A-share market in 2014, 2015, played a really pivotal role in the work that I've done to understand how passive investing influences markets. The key is there is no such thing as passive investing. If you go back and you look at the academic literature around what passive investing means, it means that you never buy and you never sell. As a result, you can't get in and you can't get out. So it's magic. Right? Now, we don't believe in magic in markets. We understand that this actually creates a mechanical implementation. And so then we can ask ourselves what happens when people are forced to buy. And price, instead of becoming a negative signal, your typical investor will look at prices rising. If fundamentals have not improved, that makes forward returns less attractive. That means they are more willing to sell than they are to buy. That creates the historical models that we have in markets of mean reversion, prices basically vacillating or valuations vacillating around something like 16 times. When you switch to passive investing, what you're actually doing is you're adding more money to things that go up, right? And so you actually kill the mean reversion that is central to all the models that we have around how markets are supposed to function. The CAPM model, for example, simply can't work in a world of mean expansionary valuations. It doesn't give you the central tendencies. And it was very interesting to me that Goldman Sachs came out with a note today highlighting that the past 100 days have been the single best period on a Sharpe ratio basis to invest in the S&P 500 in the entire history of the index. Right now, we're talking about the economy slowing. We're talking about jobs being overstated. We're talking about companies like Apple offering disappointing innovation. And the simple reality is nobody cares because they have a job, they contribute, and when they buy, they're buying more of stuff that goes up.
How much of that is contributing to the fact that we're looking at the U.S. stock markets sitting at new record highs, and perhaps because things are so uncertain and very difficult that they don't want to get active. They want to just go easy way of passive investing and relying on somebody, and these people have the money that they have to work with. Maybe that's part of the cycle.
It's a huge portion of it, and I would actually go even a step further and say most of them have no idea. And the simple reality is we changed the rules in 2006. We introduced something called the Pension Protection Act, which changed the retirement system in the United States to something that's very similar to what you see in superannuation in Australia right now, where instead of deciding that you're going to participate, you have to decide you're not going to participate. We then went a step further and we said, since we have already decided that you are going to participate, if you don't change your rules, we're going to automatically default you into passive indices. And so the vast majority of people have absolutely no idea what is actually happening with the funds that they're investing in their retirement securities.
Oh boy.
Mike, real quickly before we let you go, I want to get back to your theme of passive investing and why it's not so great, right? Would it be fair to say, to simplify it, right, the problem with passive investing is it blows a bigger bubble, and the problem comes when mean reversion hits. And when that bubble pops, I mean, that's the issue.
That is the core of the issue, right? And so, some of the work that I'm known for around this, we identified similar components around the volatility complex, the XIV volatility complex that you remember imploded famously in 2018 when I was managing Peter Thiel's capital. That was really a model of what we ultimately think is going to happen here. Unfortunately, valuations get pushed higher and higher and higher. And as valuations rise, it's important to remember indicators like the Buffett indicator that compares market capitalization to GDP is simply comparing values versus incomes. Contributions are always going to be a function of incomes. A slowing economy, a slowing labor market hurts those contributions. Withdrawals are always going to be a function of the asset levels. And so as the asset valuations and levels get higher and higher relative to the income, the inevitable outflows begin. And unfortunately, at that point, we simply don't know what happens, although we have a pretty good idea.